All right, turn around and go down Tuesday. Hey guys, Tom Gentile. Welcome to our Optionetics Tom's Trading Room live trade series. This is part 2. Glad to have you back again today. Lots to cover as we get through another session. We've got several, this is a multi-part series, and we're glad to have you here. If you missed yesterday, we have the recorded version of it, and I believe it went out to everyone yesterday afternoon. So, couple of housekeeping notes, and then we're going to get started. Number one, this session, amongst all of them, are being recorded. We'll get it out to you as soon as possible. Number two, if you have questions, comments, etc., and you're here live, you can ask them in the Q&A portion of this webinar, and we will get to as many of them as we can. Now, I'll also mention that we're not going to be able to get to all of them because we have so many people that are crowding into our webinar. So let me apologize right off the bat. And finally, number 3, you see this disclaimer in front of you? You can read it in its entirety. All you have to do is go to the recording and hit pause. I want to mention 2 things very quickly. Number 1, stock and options trading has large potential rewards and large potential risk. All right. Number 2, myself, Jay, everyone with Optionetics and Tom's Trading Room, we are here as educators to show you how it is that we trade. All right. We are not investment advisors. We do not give individualized investment advice. And everything I'm going to talk about today is in US dollars unless noted otherwise. So, welcome back again, new students. Glad to have you here. Last time we did a series like this was back in February. A lot has changed since then, and that's part of the reason why we're back. All right, you can get education, free articles, all kinds of free stuff at tomgentile.com or optionetics.com. And I also have a lot of content on our YouTube channel, and that is youtube.com/Tom's Trading Room. Okay, we also have software for those of you who remember Platinum software. This is kind of Platinum on steroids. Tom'sOptionTools.com starts at $79 a month. So check that out. Today, we're going to cover a review of yesterday, spread trading, Darknet, money calendar, and I'm going to finish up with trading the burger wars. All right, so you'll have to see what that is. Tomorrow, we're going to do reviews again. We're also going to trade cryptocurrency tomorrow. And then, of course, make sure you're here on Thursday because I will be doing the 330-300 challenge. All right, what is that? Come on back Thursday. You'll see it. As part of our live trading series. Okay, so let me get started, and now today I'm going to do a review of stocks, bonds, currencies, and commodities, and I'll go in and take a look and see if we have anything ranking today, but I'm really interested in looking at Google as well. So it's going to be stocks, bonds, currencies, commodities, and Google, and we're going to look at that right. No, not here. I'm going to place an order here, 1 or 2 before we're done for the day. But I want to go and look today at real-time intraday data. So this is the S&P. Now, yesterday, and I actually sold off and went short the S&P right in this area, this 1545 area that you see here. And then I thought, me and Mr. Smart Guy was already off to the races. But when I woke up at 6 a.m. this morning, we were actually above this area here. And I was like, uh-oh, it's going to be another one of those days. And in fact, I even had more shorts that I was going to layer into above this, but we never got any higher. In fact, the first few minutes of the day was where we put the high in for SPY. And since then, we've been trending down, and we've been staying in the red zone since about 10:35. Will we climb out of that or will we continue down? Obviously, we need a couple of hours to see where we lay out. But stocks are definitely on the sell side today, even though they're up slightly. TLT, that's the bond market. If this is green, it's telling us that the stock market wants to stay red. This is what's interesting too. Look at this move in TLT. We opened on the lows of the hour, and then we're all the way up here right at 10:30. We hit the highs for the hour. We bust through that, the 10:35 bar, and we are not looking back. And right now we are climbing and about to climb out into new highs. This cannot be good for the stock market if this thing's moving higher. The other thing I want to mention is look at UUP. UUP is the cash. This is the double dollar index. And it started out low, and it did the same thing bonds did. It climbed up, hesitated a little bit, but by 10:55, busted through the first hour high. That's that green line there. First hour high, first hour low. And where are we now? We've been trending above that high now for some time. Where do you think USO is? Let's take a look. I mean, can it not get, is this thing going to ever stop falling? Look at USO trading down in 211. I mean, right now what we have, folks, is a perfect 4. All right, what is a perfect 4? A perfect 4 for me is when I see stocks, bonds, currencies, and commodities all kind of going in the same direction, telling us that the stock market wants to drop. All right, so I'm going to show you a little trade that I'm going to place. So I'm going to go back to SPY. And we're going to look and see where SPY is right now. SPY is at the 287.77 area. All right, now I can do a couple of different trades here. And I'm going to do some small stuff so that, you know, I'm not considered that I'm front running everyone in this room. Okay, and that's probably impossible with SPY anyway. If you take a look at SPY, let's put it out there. SPY, if I were to look at put options, you know, the put that's closest to expiration is the one that actually ends tomorrow, and it's trading at 166 by 168. So I could go in here and I could do a couple of things. So let me place a, sorry. Do a little 10 lot. I'm going to buy to open. And I'm going to start right off the bat. I'm going to buy 10 of these at the market, the 287 puts. Let's place that order, get that in. Bing! That's done. There we go. Okay, so the next one I want to show you is a different way of placing an order, and that's going to be, let's go back over and look at S&P again. Now, see these lows down here? I like the closing lows more than the little stabs that happen, but we seem to have a lot of bearishness right around the 286 area. So what I'm going to do is I'm going to do a contingency order too. So I will come back over. I'm going to place another trade. I'm going to go to SPY, and I'm going to buy another put. See, it pays to get in here early, doesn't it? Now, you know what, this 287 put, I'm actually going to look at the 286 put, because if we get down to 286, it's going to be trading a little bit higher. All right, so this will be a market order. I'm going to buy to open. Let's put 10 of those in there too. And this time, this is going to be an advanced order. Now, this is an order which I'm going to look at is going to be called a contingent on price. Okay, so contingent on price looks like this. Let me turn off the put option. If the SPY decreases to 286, okay. Now, I want this to be a day order only, because I don't want this to happen tomorrow. I want this happening right now. All right, so if it decreases to 286, then what I'm going to do is I'm going to buy these 10 contracts at the market, but it's going to have to cross below 286 before we get there. The last price has to be 285.99 or less, and then this gets sent as a market order. Okay, so if I set that trigger, it says contingent upon SPY last decreases to 286 day only order. Preview, place order. All right, now that's in there right now. If we hear that ding again, I'll let you know, but I got that out there now too. This is short-term trading, because I plan on being out of both of these, the market order or the other order, by the end of the day today. So someone asked, do I do day trading? Do I do short-term trading? And the answer is, yeah, I do every once in a while, but I have to see everything coming together. All right, so that means SPY in the red, TLT, because it goes against SPY, in the green. UUP is also in the green. That means we had a strong dollar against what? Against stocks and commodities. And I like to see USO in the red zone, which is where we are right now. Okay.
Hey, James is asking if you could reiterate what the SPY trade is that you did.
Just buying at the money puts using the shortest term options available.
Thank
I
you.
bought
Thank
it on
you,
the
Jim.
market because this is, now I'm not typically a market trader. I won't do that in the stock, but the S&P is one of the most liquid traded things out there. And so that's all I'm doing. This is not a recommendation. Okay. Let me make that perfectly clear. This is education. So I'm educating you on how I look at the short-term part of the market. GLD. Yesterday I told you guys I was long GLD, and I'm long GLD by way of selling puts because I want GLD in my portfolio. But again, you know, a lot happened between yesterday and today where GLD came down into the 159s, and now it's at 160.53, as you can see here. If we remain above 160 by Friday, it looks like I'm going fishing again next week for some more GLD. But we'll see what happens by Friday at the close. So that is stocks, bonds, currencies, commodities. Let's take a look at what is on tap for earnings today. And so we have Google, G-O-O-G-L, and Google's already falling off the wagon here. Yesterday it opened at 12.94. It's been dropping since, and today we're in the red also. It's down about 2.25%. So is Google trying to tell us that maybe it might be overvalued? I don't know. I mean, you know, I don't know. All I know is that if we look at the daily, let's take a look at the daily real quick. So here's the daily. And here is, I want to show you what happened from the high to the low to where we are now. High 1530. All right, that was back in February. Low 1008. That was March 23rd. High, recovery high is what I'm calling this. Yesterday, just shy of 1300. Now we're at 1242, and we're going to be going into earnings later today. So I want to potentially look at an earnings trade. Now, I'm not just going to fall in line and take anything at the market because this is inefficiency. So I'm going to tease you with something that I'm looking at, but I'm not going to place the trade now because I want to place it closer to the end of the day. All right, but what I'm going to be looking at, let me show you what I'm looking at here. Google. All right, so I'm going to be looking at something called a put spread. And a put spread, we're going to get into here in a few minutes, is something where I'm buying and selling puts together because I don't want to just buy the puts on Google if I think that it's going to drop off after earnings. If I did that, we're looking at something that's going to be $33, $34 or so. This is expensive. What I want to do is I want to try to create a financed trade, a spread trade, if you will, that I'm able to go in and actually do this for a better price, for a much cheaper price. Looking for about a 1-to-1 is what I'm looking for. So I'm going to be very close to where the stock is trading at right now. So if the stock's trading at 1242.98 and I'm looking at the 1240, 1245s, that's probably what I'm looking to do this at, $2.50. All right, risk 250 to make 250, but I'm going to come back and look at this because all these strikes may change between now and let's say an hour and a half from now when I really want to put this trade on. All right, so what is this? This is a spread trade. This is what all of you in here should understand and know about. And to talk about spread trades a little bit means I need to go back to the teaching board and talk a little bit about why we trade options again. So we trade options for control, we trade options for protection, and we trade options in the course of paying for protection, which we call offsetting options. Now, yesterday we talked about calls and puts, and in this case, I'm looking at you know, that leverage and that protection area or speculation. As I just did, I speculated that the SPY is likely to close lower today. All right, there's no guarantee. I wish there was, but there's not. All right, so all I can do is speculate based on pattern recognition. All right, although nothing is guaranteed, when I see the same thing happening, when my patterns come up and I see the same thing happening over and over again, that's the direction I'm going when the pattern rears its head. So why do we trade options? Control, protection, paying for protection. We're going to talk about the paying for protection part right now as we discuss trading spreads. So what are trading spreads? Let's start with the bullish side because that's easier to understand for most people. All right, so what are spread options and how do we trade them? Spread options involve trading more than one option simultaneously. And what that does is that allows us to lower the overall cost of our trade, lower the overall risk of our trade, and lower the day-to-day fluctuation. Now, the day-to-day fluctuation part is something that is, well, it varies, okay? If I take a spread trade in Google today that ends on Friday, there's going to be a little more fluctuation than if I'm taking a spread on a stock, another stock that's expiration is January 2021, and the big difference is time value. Okay, but the big thing we're doing here is we're lowering the cost and lowering the risk of the trade. So that's what my intent is to do with Google. And so an example of that, if you've never done this before, is you could just, we'll just give you an example using XYZ, a fictitious stock that doesn't exist. If we bought a 100 call and that would have originally cost us $10 and we sold the 120 call and we were able to take in $5 for the 120 call, then that gives us a $5 spread price. We're able to actually put this trade on for less than, for 50% of what it would have cost us, okay? And we call that buying the XYZ 100-120 call spread. Now, what I want to show you is I want to show you an example of what that looks like if you're looking at a static risk graph, all right? I also want to talk a little bit about best practices, and then we'll go back and we'll look at that. We'll do a little bit on put spreads. We'll go back and look at Google one more time, and then I'll take any questions that you might have based on these spreads. And then we'll continue forward because we've got probably another 2 or 3 trading case studies to show you, live case studies. So let's start with a risk graph. So if this were real trade, the 100-120 call spread, it would look like this if you put it on a risk graph. All right, so the 100-120 call spread is for $5. By the way, that $5 is when you multiply that times the contract, which is good for 100 shares, you're talking about a trade that costs $500. That has $500 of risk, all right? But the way we calculate the rest of this is just some simple math, okay? So let's talk about the cost and the risk. The cost and the risk is $500. If it goes to zero, you risk no more than $500. So you, in a sense, if someone would have bought the stock at $100, they would have paid $10,000 for the position. All right. We're buying the right to buy XYZ at 100, but we're also obligating ourselves to sell XYZ at 120. And that right and obligation, that combination cost us $500, not $10,000. So we've already hedged off 95% of the cost of this trade. Have we hedged off 95% of the risk? Yes and no, okay? Yes, because we have seen stocks go to zero. And you know what? We're going to see some bankruptcies, guys. We're going to see some bankruptcies happen in not only small businesses, but there's going to be some public companies that are going to go bankrupt before the end of this year. All right, we just don't know who they're going to be. We can speculate. So when I say that the stocks can go to zero, last time we saw that happening was really back in 2009, although the one that comes to mind right now is Luckin Coffee. Luckin Coffee with their fictitious sales revenue and profit or earnings reports, and now they're being rated as a company because of fraud. And so Luckin Coffee is out of luck. But you got to go back to the Shearson Lehman and Lehman Brothers days to see those kind of things that we're talking about. Enron, you know, these folks. So when you look at this, yes, a low probability, but that could happen. The other thing is that we look at maximum reward. Now, why does this say $1,500 is the most I can make? Because anything above 120, and I'm bound to sell the stock at 120, so I can't make any more. How do we come to a $1,500 conclusion on reward? You take the difference between what you bought and what you sold, and that's 20 points. Take away 5, which is what you paid for the spread. and you end up with 15. Multiply that times 100 and you have 1,500. That makes this a 3-to-1 reward to risk ratio. The last part of this is break even. Break even is determined by taking the low side, what you bought, and adding $5 to it, and that's your expiration break even. All right? And that's a call spread. Put spreads are exactly the opposite. They're used for bearish opportunities when puts are expensive. And you look at buying the higher strike, selling the lower strike put, lower cost, higher reward, higher profit potential. Now, what I want to show you real quick is I want to take you back a little bit into the Google trade, but using our tools so that we can see all this develop. All right, so let's come on over. Let me go to Tom's option tools. Let me go to options. I'm going to go to options, option chains. And I'm actually going to type in GOOGL, and we're going to do an update. Now, we're looking at really, really cheap options because we are looking at an event. This is going to be an event-driven trade, and the event that we're hoping to drive it is the one that happens today. All right, that event is earnings. So we don't need any more than a 3-day expiration for this trade to work or not work. So come on down and let's take a look at what we have for call options and put options. And so the calls are on the left-hand side. As you can see, there's a lot of calls for Google. And then the puts are on the right-hand side. Now, what I'm looking at is the stock's trading literally right in between 1240 and 1245. What I'm looking to do is almost a simulation of shorting the stock, but with limited risk and limited reward. And to do that, I want to buy right now. This could all change, but right now I would like to buy the 1245s, and I'd like to sell an equal number of the 1240s. Buy the higher strike, sell the lower strike. That's the put spread, a bearish put spread. All right, so come up here to the top, click on risk graph, and now I'm going to show you the risk graph on this trade. Right now it shows that I can do this. It says $235, but there's a lot of slippage in here. The slippage is literally the market makers between the bids and the offers. So I'm definitely not going to put this in at the market, because if I did that, that would be stupid. Okay. What I'm looking at is putting something in around the $2.50 level. So I'm going to give them a little bit of money to take this trade. But at the same time, what am I looking at? I'm looking at a trade that if Google drops down, see this left-hand side? This is the price chart. If Google drops down, over here is my risk graph. This is my payoff chart. My payoff chart actually goes into the profit zone, 100, 200, and above 250. If Google goes up, then we have it going in the lost zone. But as you can see, I'm fixed by how much I can lose and how much I can make. All right, so that's how this trade is actually set up. This is a bear put spread. It is a one-ticket trade. And if I go back over to my order looks like this. So if I were looking to buy the 1245 puts and sell the 1240 puts, right now it's trading at 160 by 380. That's pretty wide. I like 250, and 250 is what I would trade it at, but I'm not ready to pull that trigger yet because I want to get as close to the close today as possible. So what am I looking at? Probably the last 15 minutes of the day, I'm looking to put this on. Now, what I'm going to do is I'm going to show you another one of these trades. But what we're going to do is, before that, I'm going to show you a trade that actually has 1-year options that does the same thing, but using calls on the bullish side. All right. Before I do that, however, what I want to do is I want to turn this over to Jay for a few minutes, because Jay is going to show you a couple of things in Tom's option tools that we use to locate these even calls, puts, call spreads, and put spreads. So Jay Bird, are you ready?
Yes, I am.
There you are. Oh, hey, so let me turn this over to you, and I'm just going to check the boards real quick.
Sure thing.
If there are any popular questions happening. So here is the screen for you. And while you're picking that up,
you should see Darknet. Tom's tools were in the Darknet.
Yep, I see it. Let me just check the Q&A board real quick.
Sure thing.
Guys, what I'm going to do is I'm going to take a quick look here. What do I think about Google going down after earnings? I think I just answered that question. Why are you bearish Google? Options volatility is high right now, and the stocks ran up like everything else. And everything I've seen in this earnings cycle has popped on earnings, and then we've seen a drop, with the exception of a couple of things. The patterns are to the downside heading into this earnings category. So let's see. And you know what I'll do is I will go back and see if there's anything else in here, because we have a lot of questions and comments in here about Google, about the SPY trade, about earnings, VXX, and others. So let's go ahead and turn this over to you, Jay. You can take a look at a few things here, and then I'll pick it back up.
Okay, we're specifically going to go over the two most popular scans in the tools. As most people that are subscribing to the tools are coming in for one or both of these scans. The first one being Darknet. Let me go to Home and Tom's Tools. This is kind of like home base. Wherever you are at in the tools, you want to come back and start fresh on a new scan or a new batch of research. Go to Home, go to Tom's Tools, and you're here. What you'll want to do now to find Darknet is you can click on the Options Analysis Darknet Channels icon if you subscribe to the Contrarian Trader level, or you can go to Home and then Darknet Signals. If you and when you subscribe to the Complete Trader level, you'll have access to the Money Calendar. I'll go over both of those. Quickly, we'll show you an example of how they worked with some past trades that we highlighted to some of you guys that are on this call, were in previous calls, or with another time that we were doing these sessions. So the one, Darknet, you can click on that right there. This is a technical analysis scan. Money Calendar is not based off any technicals. It's not based off different envelope channels, different trend channels, different moving averages. It's purely price and time projections based off what is done over specific periods of days over the past 10 years. But for the technical scan, we're going to look at Darknet first. And this is a bullish scan only. This is looking for stocks that are retracing in an uptrend, retracing to the point where if you put 3 different time interval channels on the stock, you can see the stock testing the support of the multiple channels. And what we're looking for is a pullback in an uptrend, for the most part, that's hitting a support level, and we're anticipating a bounce from that level to a higher price. Now, we're not looking for all-time highs. We are just looking for a bounce in the short term, and these typically play out over 20 to 30 days. So we're going to look out, at least a month for expiration. We'd like to get doubles as a target for our Darknet trades. In this high volatility market, doubles are going to be harder to come by than normal market conditions. So you may have to reduce your expectations to 50, 60%, and so on. But nonetheless, our programmers and Tom came up with a Darknet. They've backtested this to about 67 to 70% accuracy. And what we're looking at now is the Darknet screen. You'll see this middle box here. It says stock list searched. It's a proprietary list, all Darknet stocks. Leave it the all Darknet stocks. And then you'll want to do trade type displayed. Click on that drop down arrow, and you'll want to do call option trades, because we're going to start with looking for long calls, and then we can look into spread opportunities. Okay, so let's click on search. We're looking at all the Darknet stocks, looking for a call option trade opportunity. Looking back or for today, do we have any candidates? There's nothing here in the call option trades ranked by percent to double. So what you have to do then is you can go ahead and click on spreads and look for spread opportunity. What I'm going to do is I'm going to go back to a date that we found one, and this is on April 15th. Just a moment here, guys. Sorry about that. All right, so we're going back to April 15th. And what I'm going to do is go Home, Tom's Tools, or let's just go straight to Darknet. So on April 15th, when we click on the call option trades, we'll click on search. Now, one of the questions came in earlier from a student named Rama, who asked, how do you pick a stock to go look for a trade? And a lot of times we do it kind of the inverse. We look for our scan, and the scan will show us which stocks fit the scan parameters, and it's that stock that we look to do an option trade on. So rather than having a stock and going, okay, what scan will it fit on? Let's look at the scans and see what stocks populate on that. Because you can pick 10, 15 stocks that aren't fitting a scan. Why not just go to the scan and see what stocks fit the bill? So that's kind of the process. And so here you go. You go to home, you go to Darknet, you leave it on all Darknet stocks, click call option trades, and on that date, the first one on the board was TLT, the ETF for the 20-year bonds. And it shows you the ranking by percent to double. It's the lowest percent to double option, meaning the stock needs to move 4.6% in order for the option value to double. What you'll learn as you come on with more education through us, with a subscription to us, we show it in the videos that we have in our video library. We typically don't like to spend more than $5 per contract. That's based off a theoretical $25,000 account where a person is risking no more than 2% of that portfolio on any one trade. So 2% of a 25K account is $500. So instead of showing that one right there, which you can click on that hyperlink and it'll bring up the risk graph for that, let's now go ahead and use the spreads opportunity. And Tom was talking about spreads anyhow, so it's kind of apropos that we're doing this. You can click on the spreads and bring up the Darknet spreads screen, and you can click on the stock symbol and type in the symbol that you want. So since we found TLT, but the option alone for a long call was a bit higher than we like, let's click on TLT, click on search, leave all the parameters as they are, and click on search. And there was a put credit spread opportunity, put debit spread opportunity for you. Click on the hyperlink for that trade, and it'll go to the risk graph and it'll show you, okay, put credit spread right here, 314. We're bringing in 314 with a max risk of 386. We have a profit potential of 81%. This is what the tools are doing. So what do we need the stock to do? Trade higher, right? And that's what we're looking at. Here's your chart. In fact, let me go to a separate tab. You can open up Tom's tools on multiple tabs and multiple windows. All right. So here I have on 415 TLT, and you can see now, let me go to trading days and tighten this up a little bit. Click update. And you can see the Darknet B for bullish. This is a buy or bullish signal, meaning we anticipate the stock trading higher from here. Okay, so you now have the security with the Darknet bullish signal, the anticipation of this thing bouncing higher within the next 20 to 30 days. Here's the risk graph on it showing you that option that was found by the lowest percent to double. And then the only thing you do from here is just play this out. Keep your stop in place. Stops are typically around a 50% stop. We typically look for a 100% target to the upside. We reduce that now with this wildly volatile market. So let's just see what's going on. If we were to advance the stock a few days, and here's how you do that. When you have a stock chart up, you want to advance it. You can go plus a day, and plus a day, and just keep going. All right. And so what was that? 421. So on 421, you can go to your risk graph. Another way you can forward through is use this calendar icon up here. Change it from where it's at to the date you want, 421. And this will show you the valuation of that option position at the close of market. So here you've got a nice 32% return sitting there for you if you wanted to take that on TLT at this point in time. All righty, so there's Darknet in a nutshell there, guys, all right? Darknet will find you call options. You can click on the Darknet spreads and find spread opportunities just as well. Keep in mind, though, folks, that we're looking for these signals right here on the chart. And then we build the option trades around those. And those option trades are found by either the Darknet spread scanner, or let's go back and show you one last time on the Darknet itself. When you click on the call option trades, because that's what you're looking up, it will show you the stock with the signal. And there's B's, R's, and A's. B is bullish, R is reiterated bullish, A is aggressive. or you may just want to abandon. It's kind of like you can take the approach of cost averaging in. If it doesn't bounce from the B and it signals an R, here's a second chance to try for it, and the A is like the third chance. And then it shows you the slippage. We like a 1% slippage or lower, and then the lowest percent to double possible on that string, and you can go from there. All right, let me check the boards for any Darknet specific questions here. Santino says, why not have a put option trade in Darknet? Because this is a bullish scan. We're not looking for bearish opportunities with this. This is looking for pullbacks in the stocks, hitting multiple support channels or multiple trend channel supports with the anticipation of a bounce higher. So if this is a bullish scan looking for a bullish bouncing higher opportunity, we're not going to pursue anything with the put side of things on that, Santino. All right. Out of the money credit spread, iron condor. Stephen, there are multiple bullish strategies that you can employ. And I apologize, guys. I did not turn my Skype off. Let me go ahead and do that right now. So we're not bothered or interrupted by that anymore. That's done and out of the way. Thank you for that. So again, we are going to look for long call options or the spreads based off the spread searches that they found. Any other additional option strategies that you want of a bullish nature, use the tools, play around with them, build the option trades. This is not a brokerage trader's platform, folks. This is an options analytics tool. You can build option trade ideas, look at, see what they have by way of a percentage return, what their percent to doubles are, levels of implied volatility, and then based off your tools research, you can then go to your actual accounts and make the decision if you so choose. Then Rama says, which strategy is better? Well, that depends on what you like. You can use multiple different strategies. This one's back tested to 60 to 70%. I'm going to show you money calendar now. And the money calendar over a batch of trades from January to December of last year is upwards of 100 trades. It came in at around a 70% win versus loss rate as well. So you may not pick just one strategy. You may like them both. I'm showing you the two most popular, Darknet and money calendar. These are the two prior or the two most popular, and we have multiple videos on these. So Rama, start with Darknet, start with money calendar, watch the videos, learn how to do this process, and then start paper trading these and then get to a determination for yourself. And I say that to you, Rama, because you specifically asked the question, but I offer that to everybody else on the session as well. And Bill says, I take it you have several training videos. Yes, in our video library, there are multiple videos. I'm going to show you that real quick. Tom, I'm going to show them this real quick before I get into money calendar. Go help videos. Yeah. And the most important video to watch is this keyword search in this page video, because it'll show you whether you're using Google Chrome, Firefox, or Internet Explorer, how to do a keyword search. Because I get a lot of people going like, is there a video on risk graphs? Well, absolutely. So watch the keyword search in this video, and instead of waiting for me over a weekend to get to you with the video, you can go straight to the keyword search, learn how to look up risk graph, and go scrolling through and find those risk graph videos. Do the same thing with Darknet, all one word, D-A-R-K-N-E-T. Do the same thing with money calendar. Type in money calendar, and it'll highlight in the scroll bar to your right where those videos are. Watch those, get familiar with this process, and start again, paper trading this and get comfortable with the process before you take it to reality. All right, let's get into money calendar. And I'm going to minimize some of these screens over here for me anyhow. Okay, so money calendar. This is not a technical analysis scan, meaning we're not using multiple different technical indicators, trend channels, moving averages, MACDs, stochastics, and the like. This is purely what has these securities done over a specific period of time from one start day to an ending day. Now we put them on the calendar for dates, but these are actually trading days, not calendar days. We just put it on the calendar so that you have a little bit more clear idea as to when to start and exit these opportunities, okay? We have here for you a proprietary list. We update it at least twice per year. Our chief beta tester, Kevin, just did a recent update this year, I think last month it was, And so we're all updated on our proprietary list. So what we're looking at now is stocks that over the past 10 years have traded higher or lower. This is both a bullish and a bearish scan. The thing to remember though is you're not going to find a ton of bearish opportunities because this is backtesting 10 years. And we've been in a 10, 11-year bull market up until, recently with the pandemic. So, looking for bearish patterns over a 10-year bull market, you're not going to have as many as you will see the bullish backtest proving out in the scans. Each day, it'll show you out of the number of securities that hit the scan, and they hit it because they've traded higher or lower 9 or 10 of the last 10 years. And it'll show you the number of bullish, like on the 6th here, 73 of the 81 total candidates had a bullish move higher. 8 of them traded lower. As you can see, we have it color coded. We have some of our students that are green and red colorblind. So we started out with just the colors, different levels of bullishness, the higher or deeper green, the higher number of bearish candidates, the deeper color red, but they couldn't distinguish those colors. So we put these numbers in there. So your call, you can use either or both. So we were showing a group of students an opportunity here on the 20th, and this goes back the last month. We will also provide you the current month. When we get 2 months through the current month, we'll show you the next month out. We won't want to show you anything further past that. And forgive the siren going by, guys, there, if you can hear that. We don't want to go any more past that because we don't want people to play too far out when market conditions are what they are right now. We're going to use the past 10 years history for current conditions in the next month, and we'll leave it at that. Just know that we'll keep this updated. Every mid-month, you'll get the next month out. We are looking for, first and foremost, the power meter. You'll double left click on the power meter because you're going to rank it from the highest positive number to the lowest, and it'll get into the negatives. Disregard any and all negative numbers. That just what the power meter is indicating, and I'll click on take 2 here, PTWO. The power meter is showing up right here in your yearly trade results. The past 10 years. This is, if you put the cursor on a bar, it shows the P&L for that year. From the start to end date, TTWO went up 16.5 points. You can click on that bar and bring up the candlestick bar representation of the start to end date and how that trade panned out on the chart. You can see that 9 of the 10 years are green, meaning it had a positive profit move. This is not assessing direction. You're going to see a bearish opportunity that's going to have green bars here. It doesn't mean that the stock is going higher. This is assessing profit and loss. Were you profitable? Did the stock move higher for a bullish candidate? Yes, it did, 9 of the 10 years. But are we getting higher with the profit moves in the more recent few years versus the cumulative 10 overall? Yes, that's what power meter is assessing. How are we doing in the more recent years versus the overall number of years? The higher the number, the more indicative of the profit moves being higher in the more recent years. Well, that's what we want. Positive power meters, higher the better. Okay, let's go back and view day. Or let's go back and view the calendar if there's anything more I need to show you on the calendar here. I think that's well covered. We got the color coding and we got the numbers to back it up, all right? What we typically do is look for these on Mondays. They work on all days, but one of our programmers, Miles, who's responsible along with Tom for the Monday calendar, found that Monday was our better, higher, more reliable day for a start date trade. Second day was Thursday. They'll work on all of them, but the better numbers play out on Mondays. Second to that is Thursdays. But there are sometimes where we're doing these live trade sessions where we want to look at what's going on right now. And I'll show you an opportunity for the 28th here today, the bearish opportunity. As you can see, we go more bearish from today on through the rest of the week. All of our days have a majority of bearish candidates versus bullish, okay? But here's the one on the 20th that we were showing everybody on Cisco Corporation, SYY. You see the number of days, it's a 20-day out trade, meaning the end date is May 15th. So from the start date of April 20th through May 15th, Cisco makes a move of about $1.34 higher. That's the average profit column here. And it had a positive power meter, 90% accuracy. It will not hit this scan unless it's 90 or 100%. So when you click on SYY, what we teach people to do is write the information down. Paper symbol SYY, closing price, average price. You add the close price and the average price, because we typically advocate you do this at the end of the market day when the markets are closed and the intraday machinations don't freak you out. Like you're looking at a bullish opportunity on Cisco, but it's down 30 cents on the day. That gets people to thinking, oh, well, it's trading down, we shouldn't do this. No, don't let the intraday stuff mess you up. You take the closing price, the average price, and you add that together, and that gets your target price. That helps you set what option strike you're going to entertain for your option trade. And then your end date, May 15th, you want to know that too. And then you want to look at what expiration is just past May 15th. Or is May 15th an expiration? May 15th was an expiration. You can go May 22nd if you want. You can stretch it out a little bit further if you like. Here's the deal. We have this, should have this as a saved trade. Trades, saved trades, saved trades. Let's go to, there it is, SYY. Okay, let's bring up the risk graph. This is what's going on right now. So on April 20th, we looked at, okay, this is what's good. This is April 20th. This is the trade at the time that we looked at. We looked at a 50-55 call spread, okay? We have earnings coming up on SYY before market open on April 5th. So next, what is that, Monday or Tuesday? So we like to go for 100% returns on these. Again, with the market environment, you may need to scale it down to a 50-60% return expectation. And the fact that we are not going to be able to hold this stock all the way through until expiration, or excuse me, the end date or the expiration, is because of earnings, we had to lower our expectations for a return anyhow. We try to set these up so that our price target on a spread is higher than the sold strike that we sell. Okay, so if we're selling a 55 call, we need SYY above 55 at expiration to exercise in the account and bring in that max profitability of $278, 125% return. But again, we're going to get out because we don't hold our option trades over earnings. So here we are on 4/20. Let's go ahead and update it to the latest date today. And you can see that it changed to 4 offsetting legs not displayed because we just went ahead and sent an alert to the group of folks that were monitoring this in previous sessions and such to close the trade. And here we are. We were able to get out of this and book a 60% return. So I think we were in at 225. So 135, $1.35 over 225, what was that, like 370, somewhere in that ballpark? But nonetheless, here's your credit, here's your profitability, 135 bucks. Okay, made 135 on a 225 cost. Okay, nice little return. If you want, you can go to trades, save trades, and look up the back test on just that alone. So let's click on that column there, which says check trades for profit and loss. Click your profit and loss. Click on the back test right here, and you can see it right there as well. There's your profitability today, $1.35 as you're closing that out. Okay, so that's a past example of a Cisco trade that we found with Money Calendar. And I showed you what you do. You look for the positive power meter. There's additional rules, like we want the last loss to be within the last 3 years. It's not a deal breaker. If it's the last 3 years back that you saw that red bar, that would be okay if everything else works out and looks good. If it's last year that it was a loss, or the year after that, like the last 2 years, we almost always avoid those. But 3 or back, we're fine with, okay? You write down the information, guys. You're expecting this thing to play out like it has the past 9 of 10 years, trading higher, an average of 134. Sometimes Tom and I will do it like this. Okay, 134 is the average, but look what it's done in the last few years. I mean, we're looking at 2, 4, 5, 8, 9. So we're up over 2 points now on our average trade expectations if you use just the last 3 or 4. So if you do like Tom and I, and we look at the more recent years, we will take that average profit move over those handful of years, add to the closing price, and that becomes our price target that we'll build the trade opportunity around. All right. So let's get into today as I wrap this up and get ready to turn it over to Tom. Okay, we're looking at bearish. That's the overall assessment of the securities over this upcoming week in Money Calendar. Click on the 28th. We double left click on Power Meter. And booking, we like them 20 days or higher, but we may have to do like 15 to 20 now because markets are just jumping all over the place so quickly now. So a bearish opportunity, synaptics. I didn't like the spreads, the bid-ask spread on the options. The one I wanted to highlight, because this is the one that we've been talking to a lot of folks in prior sessions with, is on STX. So here we are, April 28th. We can click on the symbol over here and alphabetize them. Roll on down to STX. And it has a positive power meter, end date May 19th. It's a bearish opportunity. And you can see the last 1, 2, 3, 4, 5, 6, 7. The last loss was 7 years ago. We would like these profit bars a little bit higher over here. But nonetheless, we have a positive power meter. So we won't necessarily like highlight a trade and have Tom show you in his trade order screens for 12 Street Smart Central and such. But let's take a look at what we would do though. Okay, we want to write down those ticker symbol STX, and I'm having you guys do this. You can watch the recording and do this as well. Write down STX and at least track it out over the next handful of days. At least watch it through May 19th. We are past earnings. The reason we didn't do this in earlier sessions with some of you guys is because the earnings was in front of us. Earnings is behind us now. We have an opportunity for a bearish candidate here on STX with an end date. So write down your end date of May 19th, which means I'm going to entertain a May 22nd expiration. Whether it's a long put, a put bearish spread, or a butterfly lower, or any number of bearish option trade opportunities, we're looking for a May 22nd expiration. What's the current price of STX? We will treat this like it's the close of market, guys. What is the current price on STX? Javier, we're doing one for today's date right now for you. And we're doing it as a bearish opportunity that many people were asking for. So I'm taking care of multiple people with a request for a opportunity today and a bearish trade for today. So 49.15 is what I'm seeing. Okay, 49.15 with an average drop price of how much? $1.70, $1.69. What would be our price target lower, guys? 47.46. So there you go. 47.46 target, May 22nd expiration on STX. 9 out of 10. There you go. Okay. If you want to go look at just a put opportunity, here's one thing you can try to do. You can go up to searchers. Let's go to the current date. Go to searchers, multi-strategies, find trades, and type in STX. Click change, because it changes the information now that you're looking at in these different parameters to STX. If you type in the symbol, don't change the box right here. It's going to give you all the data from the previous symbol that was there. So we're bearish, mark that, less than 45 days. And we can start with a buy put and click search. We're looking for a May 22nd expiration. So when the screen refreshes here, if you don't see a May 22nd over here in this column, you have to go back and do it the old school way, okay? But here is let's not do the halves. Let's just go with the 50. A little bit more efficiency in the options on the round numbers versus the halves. So there's a May 22nd, 2020 put, a $50 put at 247. Click on that, and there is a possibility for you guys. There's your chart. Earnings already happened, trading a little bit off from that, and we're expecting this thing lower. Okay, it's less than the $5 per contract. We like that. Everything else met up, and then you can go from there. Now, let's say, where does it need to go to double? It needs to drop to 45.11. Our target is 47.46. So if we had to hold this until the 0 days left till expiration, our target says it will not reach that 45 by that point in time. Based off its average, we're looking at a 47.46. So one last thing you can do with the tools is you can go to these stop limits, lower and upper. And what you're doing is you're changing the lower number on the stock price grid and the upper number on the stock price grid. And let's go and put that lower number at our target of 47.46. Click apply the settings to the risk graph. And now you can see over different intervals from now, the red line, until expiration, if the stock hits our target at any of these two intervals here, you can look at the price valuation. So there's an $81 profit, okay, if it happens in the next 8 days. Okay, 81 on 247, not too bad, okay. What if it keeps dropping and you get a little bit closer to expiration here? Your profit's going to go down a little bit. So we need this to drop sooner rather than later is what the risk graph is showing you. And we can get into more of this, folks, as you guys come on board, as you guys are getting through these live trade sessions Mondays through Wednesdays, however long Tom is going to do it, Mondays through Wednesdays. Or if you guys are a subscriber, this is the training that you guys get in the tools, in the video library. Again, look up Darknet, look up Money Calendar. It'll go over the percent to doubles with both. It'll go over other trainings and some of these parameters here for you. All right, Tom, unless you see anything else I need to address, that wraps it for my portion here.
No, the only thing that came up, Mark is asking about, he mentioned something about limited open interest, and May 22nd isn't a liquid area. If you want to comment on, or not a liquid strike. You want to?
Well, open interest and volume, as you've taught, as I've learned from many an optionetics instructor, and as I employ, we're looking at the bid-ask spread of the option to dictate liquidity versus open interest and volume. Open interest and volume are definitely indications of liquidity, and you can see OI is 23. You may have heard a rule you want 100 or more. Here's volume of over 7,000. So I mean, I think we're good there.
Right.
But you want that spread between the bid ask. That's 7 cents. Okay, that's a pretty tight bid ask spread, especially in this market. Holy crud! You know, we're usually looking at like 2.5 point spreads on some of these things. This is a 7 cent spread for that option right there. And if you can get that spread within the 1 to 1.5%, meaning you take the stock price, you divide the stock price by the difference of the bid ask spread. So take the stock price divided by that 7 cents. And you want it in that 1 to 1.5% range. Some stocks we have more familiarity with that we'll go ahead and we'll be comfortable taking a trade with a little bit higher slippage than that 1 to 1.5%. Mm-hmm. But that's typically the rule. So volume open interest isn't so much our gauge as we're looking at that slippage mark. Okay.
Excellent. You've learning. That's exactly what my answer would have been. Because we have discussed that time and time again. So yeah. Great answer. Couldn't have put it any better myself.
Thank you, sir.
All right. So since you've been talking, Jay, I should just let you keep talking because the markets have been dropping and my put options I put on have been going up in value. So thank you.
Yeah, you bet. Maybe I'll just leave the mute button open.
That's right. So this is kind of where we were when these went on. They've a little bit of a drop down, and they've started moving higher, and we've hit 2 just a moment ago. I think I was filled around the 165 area, and so awesome. So we'll see where those end up going. You know, the other thing I want to mention is GLD. Now I'm going to share this with you on Thursday, but GLD has a short-term pattern trade that rises into the close from it during the afternoon, and it's done that for the last week consistently. And this drop down and the slow move up suggests to me that might end up happening again. So I went ahead and bought some calls, some at-the-money calls on GLD that expire this Friday. And we'll see. And my plan is to ride those into the close also, and just get an idea where they're going to go. They may not go up that much. It might come up here and tag this area here, but we'll see. I mean, that's GLD, and what I'm looking at is just this series of higher highs and higher lows. And I got in right around this area here where we are. So we'll see what ends up happening if it decides it wants to start trending up higher. But those SPY puts are definitely heading in the right direction. We'll see where those go. So I want to show you guys spreads, but in a different way. We're going to look at going to look at the burger wars. So let's talk about the burger wars and finish off here. And I want to let you know too, I put the link out because so many people were asking where to get the videos for Tom's tools and where to find the videos. Regardless, there's a couple places you can go to tomsoptiontools.com, but also if you subscribe to the YouTube channel, we put it's the same thing. It's literally the same stuff is there. And so what we do there is that if you subscribe to that, you'll get notified anytime we put anything new out. And I've got a new video. This one's going up on the channel because all the videos we're doing this week are going up on the channel for everybody to see. But some of the stuff we do is members only, and so that won't go up there. But this week we got all of them going up. But I've got a shorter one, about a 10-minute video going up on the burger wars, if you want to check that out on its own. But I'm just going to give you the highlights of that right now. So Burger King or McDonald's. And so did a little research, and in that we looked at the fundamentals of McDonald's, 5.53 billion, net income at 1.57 billion, up 11%. You got a company that's very recession resistant. It's a cheap alternative to dining, and there is no alternative to dining right now because no one can dine. In fact, they're looking at some ways of allowing people to dine on patios coming soon, just making sure we have that plenty of space. I think the dining option is going to be a real pain to begin with. Getting back to work and getting back to life is going to be a slow go. But you got McDonald's, which is very well positioned because of the way they can adapt to these type of conditions. And hedge funds have come on and risen about 15% in the last year coming into McDonald's. Even before this happened, we don't know how many have come on in the last couple of weeks, but I imagine more are coming on than going off. When we look at the fundamentals, you can see here based on the candlestick chart, the highs that happened to McDonald's were just below 220. That was in February. Oh, and someone had mentioned to me, is there any way that we can, let me just show you real quick. Is there any way that we can go in and let me just show you what I'm talking about here real quick and highlight what we're talking about. Let me toggle this on. So now I got a little blue cursor. So I'm going to jump back. I'm going to go backwards a little bit here and take us back to past Burger King. So McDonald's. So Jay, how's this look? High here, out here at 220. Low down here at 125. The high that when we get the rebound high sitting up here around, and the stock price is on the left-hand side, guy. Don't look at the 70 as a stock price. This is the options implied volatility level, right? Which was at over 100, and now it's come down into the low 40s, right? But price has gone from 220 to 125 back up to near, just above 185. All right, so it has made an interesting move. Burger King is a company that is no longer publicly traded under Burger King. It was actually acquired several years ago by Restaurant Brands International. It's part of that brand of their various restaurants. Okay, now Restaurant Brands had a quarter that was 1.8 billion with earnings at 165. So they're lower growth, all right, but still profitable. The risk that they have is right here, all right? The fact that Burger King is not the only restaurant in their portfolio. So there's risk out there because even Burger King, which I think has been doing a better job getting a hold of their customers than McDonald's. They've been attacking it on social media. They have been out since COVID-19 became an issue back in February. They've got some awesome commercials, including that couch potato one, where we should all do our job. That the country needs us on our couches. I think that's a fantastic commercial. So they're doing well both online and traditional advertising. But when you do the comparison, or when you look at them first and you compare the stock prices, they had a high back in the 60s. All right, high 60s. They bottomed out down here at $25, and they've had a nice little rebound as well that's taken them back up to the high 40s. Now, take a look at their implied volatility levels, though. IV was down here just below 20. IV went up to 220 as they dropped out. IV's dropped, but IV is still at 70. So when you compare these two stocks, fundamentals, McDonald's takes first place here because they got more revenue, they have more earnings, but more importantly, they have more growth. They have double-digit growth, right? Technicals is really a draw because when you look at the chart of McDonald's and you look at the chart of QSR, you can see that they both had highs, they both had lows, they both recovered, and even though the stock prices are different, the percentages remain the same. The big difference is the options. McDonald's has much lower implied volatility than QSR, and it makes their options cheaper on an option price to stock price ratio, okay? That's how you have to view it when you look at these. So there are two charts that I'm going to present to you right now. On the left-hand side, we have McDonald's, all right? And McDonald's is trading at just above $185 a share. So buying 100 shares of this stock is going to cost you $18,500, all right, or really $18,589 plus the small commission you might end up paying, if any. Over here to the right, I have a different setup, right? This is actually looking at the May 190, 195 calls, but I want to take you out past May. Yes, McDonald's has earnings coming out on Thursday. But you know what? I don't like this one. I don't like this one because I think McDonald's is a long-term play. I don't think it's a short-term play. So what I want to do is I want to roll over to our tools, and I want to bring up a stock and option table, and I want to bring it up on MCD. All right, and we're going to look at 10% above and below the stock price, and we're going to go ahead and update this. And what I want to do is I want to look at the January 15, 2021 options, because I want to look at this more as an option investor and not as an option trader, right? Because McDonald's has had a nice run up, and they could get a little bit of a pullback if this whole market decides it's going to continue to pull. So we have to keep that in mind, and we want to look at potentially being an option investor. So here's McDonald's options for, again, look at this, January 2021, all right? 262 days remaining before expiration. So this gets us through a few earnings cycles. This gets us into some knowns and out of the unknowns. If we look at calls on the left, you can see here that with the stock price around 185, the 190-200 call spread might make the most sense. And again, not a recommendation. What we're showing you here is how to take something that would cost you normally nearly $186 or $18,600 and reduce the price from buying the stock to renting it, all right, with a longer-term lease. And that long-term lease is 261 days. And if you bought these calls on their own, they'd cost you $17.40. But by doing the call spread, the call spread, giving yourself the right to buy at 190 and obligating to sell it at 200, you're able to do that for the low price of $450. Okay. You can see here, 190 calls, 1740, 200 calls, 1290. That trade going together, right down the middle, it's 450. There's a little bit of slippage on both sides, but as you can see here, we're not really concerned about what happens to McDonald's in the next week. This is more of a trade that goes on through the rest of the year. All right. Fixed risk, fixed reward, based on the 450 number, this is better than 100%. In order for McDonald's to have 100% return on the stock, this thing would need to go to 370 by January 2021. All that this option has to do is get to the break even, which is going to be 194.50 to break even. You get to 200, and it's more than doubled its cost if you hold it all the way out until expiration, and the stock is above 200. Okay. So I wanted to end on that and just show you kind of the burger wars. My last question to you, to all of you who are watching, if you are a fast food junkie, not even a fast food junkie, I'm curious. This is just my, I should have done a poll on this, and I would have been happy to do one, but I wasn't thinking about it until just now. Burger King or McDonald's, which do you prefer? So if you want to put that in the Q&A box, then I can look at that and see what you think. And I'm seeing so far it's right down the middle. And so is the word neither. That's also, so it's about a third. And I did a poll earlier on the subject, and it literally looked like a stock poll: bullish, bearish, neutral. All right, Burger King, McDonald's, neither. And so it depends on whether you like fried or whether you like flame broiled, whether you like meat or whether you like meatless. And so anyway, guys, awesome. And Chipotle came up as a as an answer, although that wasn't part of the question. That is definitely an answer. Guys, everything we talked about tonight or today, we have discussed in, as a rules-based trader. At OptionX and Tom's Trading Room, we look at spotting rules-based opportunities, creating low-risk or high-probability trades, and then planning them from start to finish. All right, so what do I have on tap for tomorrow? Well, tomorrow what I'm going to do is we're going to do a review of what we've learned in the last couple days. Then I want to talk about cryptocurrency, because I think cryptocurrency, believe it or not, is one of the safest investments to get into during volatile times in the stock market. I'll tell you about how. We'll talk about some other things regarding cryptocurrency. And tomorrow I am going to also talk about something that I am doing that I only do once a year. All right. Way of mentoring with me for 2 months, for 2 solid months of mentorship. And so I'll talk about that. I'll scratch on it a little bit tomorrow, but we're going to officially launch it on Thursday. So anyway, guys, that's it. Recording will be out later today. Again, any questions on this webinar, you feel free to email us, support@tomgentile.com. And I did mention, and I put out there, that if you're interested in looking at the videos on not only Tom's option tools, but videos in general on how we trade options, etc., then check out our YouTube channel. That's youtube.com/Tom's Trading Room. I put a link in the chat box for everybody to look at. All right. And then if you're interested in our tools, they start at $79 a month, which is quite reasonable when you look at all that we have to offer. All right. Hey, have a great afternoon, and I will see you again, same time, same channel tomorrow. And we're going to get into a review of all of this. If I have any other trades I'm looking at, I'm going to be happy to share them with you. I'll let you know what I did with Google tomorrow, but I'm looking at some sort of bearish trade wrapped around the strikes that are happening right now. So thanks again. Have a good afternoon. We'll talk to you tomorrow. Bye now.